Okay, so welcome to this tutorial session with me, accounting tutor John Katita. In this tutorial video, we're going to be looking at the income statement. So basically, how do you go about preparing the income statement? So before watching this video, I'm sure you watched the previous video, which was about the trial balance. So basically, before you prepare any financial statements, which refer to as the income statement, trial balance, statement of financial position, and the accounting ratios and cash flows. So these, before we prepare these, we always start with the trial balance. So it is from the trial balance that we used to prepare the income statement and also the statement of financial position. So then, how then do we go about um, preparing the income statement? So the income statement is based on the across concept. It is premised on the across concept where we say we recognize revenues and expenses in the period in which they occur and not when money is realized or paid for. So in this particular case, we are saying we are supposed to record transactions, which are the revenues, expenses, as soon as they are, so if as soon as revenues end and as soon as the expenses are incurred, we're supposed to recognize to say, okay, this is what we have incurred during the year, because we always prepare these accounts for the year end. So the income statement is always prepared for the year ended, the respective year that you're given. So you want to know what's your total revenue and what's your total expenses. Then from there now, you find your profit. So basically, this thing is divided into two parts. So the across concept is also known as the matching concept. So on the matching part, we are saying we match all the revenues that we have during the year and then to the expenses. Then the difference that we have is our net profit. So basically, that's what usually happens. And then the income statement. The reason why we prepare the income statement is so as to determine the profitability of the company. So you want to be able to determine what's the profitability of the company. So we see this using the income statement, because we say in the preamble we say accounting is the process of collecting, recording, summarizing, and the interpretation of your financial statements to the end users. So these end users will require to see something, which is the final account. So this is what we present to our shareholders if you want to see how profitable the company is. So it's very much important to also know the uses of the income statement. And then when you come to statement of financial position, statement of financial position is just basically prepared in order to determine the financial position of a given of a business at a given point in time. So that's basically why we prepare this statement. And then, having said that, it is very much important in financial accounting, before you answer anything, to know the format, because that's what is going to help you. Accounts is more of entries, as compared to like these other courses and all that. So for our financial accounting, for every correct entry, the mark it's a mark. So the most important thing is you knowing the format of how to go about it, um, each respective statement that you're preparing. So if you're preparing the income statement, so specifically for this video, we are going to be looking at the one for a sole trader. So how then do you go about it? The format of a sole trader. So the format of the sole trader looks like this one. So this is our format of a sole trader. So it's very much important that you know where to put what, because you just be given a trial balance and then they tell you to say prepare the income statement. And then also, if they factor in the issue of adjustment, it will be more easy for you to be able to record transactions if you know how the income statement looks like and how the statement of financial position, because it will be more easier to know how to adjust even the adjustment and all that. So we always start with a title. In financial accounting, it's very much important to put the title of what you're writing. What are you writing? So you first write the name of the person you've been given. So like in this case, I picked the name Deborah Lufundazi, income statement for the year ended 31st December 2024. So in this particular case, um, here the income statement is always for the year ended. So whatever you're going to write, sometimes they may tell you to say statement of profit and loss, which also means the income statement. So you can either use the other one, the income statement, or statement of profit and loss. But at the end, it's always for the year ended. You write the date as at when for that year that you're given. Yeah, for that year that you're given. And then you proceed. You have got these three lines, and then you always start with sales in your income statement. At all times, you always start with sales. And then from the sales, if you have got any returns that you made, you list the returns. So if you have got returns, you always adjust from the second column. But if you don't have returns, just direct your sales on the last column. And then, so because we have got returns here, so you just adjust from the second column, and then the total will be taken at the end, which is called net sales, or sometimes they can call it turnover or revenue. So sales is also turnover, is also revenue. So sometimes don't be confused in questions if they give you uh, sales, or they give you revenue, or they give you turnover. It just basically means the same thing. And then aside from that, we have got the cost of sales. So whatever is down here is just the computation of cost of sales up to here. So the difference between your sales amount, your net sales, and your cost of sales is what's known as your gross profit. But then how do you find the cost of sales? We add the opening inventory, you put there in the middle column, always on the middle column. Purchases, you check, do you have adjustment to purchases, like things like carriage inwards? Returns, how to watch the purchases returns. Any goods drawn, yeah, the goods drawn in kind. If the order of the business gets goods for personal use, we subtract from here. And then the figure you're going to get to be your net purchases, you add it back to the opening stock. And then what you're going to get here will be your total stock available for sale. And then from there now, you list your closing inventory. The figure you're going to get to be your cost of sales. So that's how you go about finding cost of sales there. So that's addition of opening inventory, purchases, net purchases, less your closing inventory, then you get your cost of sales. And then now the difference here between your sales amount and your cost of sales is what's known as your gross profit there. And then from the gross profit, you're going to check, do you have any other incomes or gains that you have? So things like discount received, this commission received, rent received, bank saving interest, profit on disposal, decrease in provision for bad debts. So all these, if you have got two or more incomes, you adjust from this column. If you just have one, just take it directly, you add it back to the gross profit. Then the figure you're going to get to be your total gross profit. But these, the total of these gains is called total incomes or gains here. Then you add it back, you get your total gross profit. Then you proceed. So from here now, from your total gross profit, where we less our expenses, you come to less expenses. So this is the format. This is how you're supposed to present your information when you're given to prepare. This is how the information is supposed to be presented. So a format is what you always refer to. So in accounts, you have got rules, principles, standards. So we always follow that. It is as per standard, as per rule, that you need to prepare the income statement like this. So if anyone asks you to say, why are you doing that? You tell them it's because it is a rule in financial accounting. It's in the format. That's how you go about it. And then you proceed. Carriage outwards. Discount allowed. So these are I was just trying to give examples of the expenses. Some of the expenses, because the list is endless, and yeah, some of the incomes and all that. But I just made sure to put most of the common ones that you usually encounter. Yeah, so from there now, you put your expenses, electricity, rent, wages. So these are the type of expenses there. And then from here now, all expenses are always put on the middle column so as to adjust. And then when you add the total is what you're just going to take to the last column there. So here you put your right total expenses, then you subtract from the total gross profit. The figure you're going to get will be your net profit or loss. So if your total gross profit or your gross profit there is greater than the expenses, meaning you have a profit. But if this one is less than your expenses, meaning you have made a loss. So a loss is shown in brackets. So that's how you go about the income statement. And then you proceed to the statement of financial position. How then do you go about it? Statement of financial position. So the same way here, in the statement of financial position, you always write a title. So you write the name of the person. So in this case, I gave Deborah Lufunda statement of financial position as at. So for the statement of financial position, which is also known as the balance sheet, we always say as at. The date you are given as at that date. So for the income statement, note that we say for the year ended, but for the statement of financial position, we always say as at. And then now, from there now you proceed. This is how it looks like. You're going to write here cost, depreciation, net book value, NBV. And then you always start with your non-current asset, because in the statement of financial position, we always try to prove the accounting equation where we're saying assets are equals to capital plus liabilities. So we start with our assets. So always start with non-current assets, go to current, and then you come to capital and liabilities. You put your capital, non-current abilities, and current abilities. That's how you go about. So your non-current assets, these are just some of the examples that I give. There are many more non-current assets that you can give the examples and all that, but I just chose this for the sake of just fitting on the page. So there are also other more non-current assets. So these are just the examples that I gave. So you get the cost you put there. This depreciation, we always get the yearly depreciation plus the opening accumulated dip that we always find in the trial balance. We add them together. So once you find the yearly dip, which is found under the adjustments, you add it back here. That's a dip you put here. Then you subtract, brackets in accounts, it means subtraction. You get your net book value here. And then just like that, as you are seeing, that's how you add the totals there. When you subtract this from that, you need to get this, or when you add these, you're supposed to give you the same answer. Then you proceed to current assets. So this closing inventory is always given under the adjustments. That's one you always put here. Yes, and then from trade receivables, this one, the provision for bad debts. This is the closing provision, the one you find under the adjustments, not the one in the trial balance. That's the one you always subtract from here. And then you get your net receivables. And just like that, cash at bank, cash in hand, any prepayments that you have, accrued income, accrued income also put here under current assets. Then you get the total, you say total current assets, you put there. So the addition of your non-current assets plus your current total current assets is supposed to give us your total assets. So it means you have found one side of the accounting equation. We have only found our assets here. We also now need to find, we add our capital and our liabilities to get to our total assets. So we should be able to find the same figure. So you put this as a balancing figure, you put it aside. Then you come to capital and liabilities. So financed by capital. So you put your capital there. Net profit. So this profit here that we found here, net profit, is what we come and put here. We add back net profit. If it's a loss, you subtract. Then less drawings, you subtract there. You're supposed to put in brackets. For drawings, you subtract because I said less. And then the total you're going to get will be your capital employed. Yeah, you put the total there, and you continue. Non-current, you always start with non-current. So non-current abilities, things like debenture, long-term loan, mortgage, those things. These are liabilities. So you add the total, you put there. You come current liabilities. So things that we have like trade payables, um, bank overdrafts, accrued, outstanding, due, owing expenses. So all balances, all expenses that are accrued or outstanding or due or owing just means the same thing. It means that we are still owing and we have an obligation to pay as a business. So if you have got an obligation to pay back and you haven't yet paid, you're supposed to pay in that particular year. We add it back here. This is under accruals and prepayment. And then we also have short-term loans. You put there the total you're going to get. You put there as your total current liabilities. So bank overdraft is a situation where you have overdrawn more than what you have in your account. So you have overdrawn more than what you have in your account. Then you're owing the bank. Trade payables is the people that you're owing money to as a business. And then you add the total now. Capital employed, total non-current, and total current. This figure should be able to give us this one here, our total assets figure. If it's not giving you that figure here, it's not coming out, it's not equal, it means that somewhere you have made a mistake. So basically, that's how you go about preparing your financial statements. So look out for my next video that I'll be doing up an income statement question.